So I have the pleasure to introduce you to three panelists that have a different perspective on impact investing as an institutional investor. And I'm a bit surprised that until now nobody has shown a kind of overview of the different aspects in impact investing. And I only show the slide as somebody asked me, is this really impact investing, what this guy on this panel is doing? We might come back to this later. And even I'm working for an association, the Forum Nachhaltige Geldanlagen, that's dealing with different definitions and trying to set standards. I'm not the one who's trying to tell you what is the wrong or right definition. I will just demonstrate that here you will find a range of different styles of investing that include impact in a very intensive way or in a way that is not intended. And philanthropy on one end is an area that will be also represented by Niklas, who's representing a foundation, but that's not the aspect we will be talking about. So we will talk about the different areas of impact investing and why institutional investors have entered into the space. Just to tell you, it's a significant area of growth, and these are the recent numbers of sustainable investing in Switzerland. And you see impact investing compared to all or to different other techniques and market segments in the area of sustainable, responsible, and impact investing is rather small, but it's growing at a significant pace. And I won't get back to the definition. Just now I will approach my three panelists, and you will find their bias and their background in the booklet that was provided. And so I just start by asking them questions to introduce themselves. So Rhea, I want to start with you first and just ask you to explain what is the impact of the investments you have made? You have different roles, and so please tell us.
Great. Is this on? Yep. So I've come from almost a 20-year, 2 decades of experience in investing in areas of energy, clean energy, resource efficiency, water, etc., and across different organizations. And I think the impact in those organizations that was measured varied significantly. So on the corporate venturing side, where I managed a portfolio, we were mostly concerned about license to operate. Wherever we were, we need to make sure that the conditions, whether it was social, environmental conditions for those companies, were in a state that we had a license to operate. So we actually, at that point in time, weren't measuring any specific ESG factors. I then moved to a financial institution, who some of you know very well, which is Robeco Sam. Robeco Sam was on the opposite side and has a very large questionnaire, an ESG questionnaire, that we get everyone to fill out who we look to see as investable, and we run the survey of how they compare across the ESG survey that we've put together. The last role that I've played, I've just came up from a family office where I managed their renewable energy infrastructure investments, as well as their, let's say, clean technology, energy efficiency technology investments, which were more venture capital and growth equity investments. And there, to be honest, the family office got into that investment class and those types of investments because they were extremely interested in the opportunity that was there, and there was no rigorous thought behind how we're going to measure the impact. Can we invest in this or not? We really looked at it as, no, these are good investments, these are sound investments, they're long-term sustainable investments, and that's why we made those investments. So there's sort of three different aspects of my career and how we looked at the impact across different organizations.
So Ralph, you're looking for managers in impact investing, or just now the second question, do you categorize the investments you're looking as impact investment?
I would say the short answer is yes. And I think Andreas Nielsen before provided a very good framework that we can actually use. So first of all, let's make it simple and say that the difference here is that we also invest in private equity, but a wider spectrum, which also includes private debt or infrastructure or real assets, just as sustainable timberland, microfinance. I think the most important is that our focus regionally is not limited to lower income countries, but globally. And the reason for that is if we turn to the speaker before, where we talked about climate impact and climate risk, and then we see this is global and it essentially hurts, the poorest first, as we all know. So that's why it is global. And the second one is we don't have own product and we don't market or sell or distribute any product, but we're actually working exclusively for asset owners who don't have the specific resources or specific skills, but wish to build a portfolio of good alternative investment funds and create a portfolio.
Thank you. So, Niklas, you're working for a foundation, and I think there are different connections between your foundation's activities and impact investing. And so can you please elaborate on this and also tell us where is the borderline, which part of your capital deployment would you define as impact investment, and what is charity work?
Yes. So I work for a family foundation, which sits in a wider network of family foundations and also an impact investment fund. And so the family foundation, Argidius's focus is basically on building the ecosystem of support which enables enterprises with a social and environmental purpose to grow and develop. So basically we're producing pipeline. And we're doing that in Africa, and we're doing that in Central America. And that's primarily, though not exclusively, through grants. Though sometimes the business development intermediary is itself an investable product. And so the foundation will actually make an investment in that business development service. So we have a consulting firm in East Africa, which we've actually invested in, which then provides support to high growth businesses, which would be invested in some of the funds we've heard about today. And then on the other side of, not quite the fence, perhaps the garden wall, is the impact investing fund, which has taken a portion of the underlying charitable foundation endowment and is investing it against impact criteria that reflect the interests of the foundations, but is doing so in order to make a financial return, which will then generate resources for the philanthropic activities of the group.
So, and the second turn I wanted to do is to talk about the motivation of institutional investors, and you see that there are already different perspectives from these different institutions, and you have already mentioned some of the motivation, like Rhea, you said that, the family office you've been working for, they saw your renewable energy infrastructure investment, it's a sound investment. So can you explore a bit more on the motivation? And when you talk now to other family offices, do you see that this is mainly the motivation they're driven by, or which other motivations are behind?
Sure, maybe I'll take the first part of the question, which is maybe how we got into this area and the motivation behind it. And in part, the family office that I worked for had a very visionary CEO, and that helps because they really looked at, okay, where are the opportunities? And at the time, we saw a huge opportunity with the amount of investment going into renewable energy. And so we said, okay, let's look at the sector and see where we as a family office would be very interesting to invest. They invested in two areas. So one was on the infrastructure side, renewable energy infrastructure for family offices is a fantastic investment because family offices can hold the investment for 20, 30 years. We don't have the issue with funds of having to flip after 3-4 years. The other side was really on the technology side. We said, okay, where could we invest where we know that as more and more renewable energy goes onto the grid, where's the opportunity going to be? And obviously what's happened over the last 5-10 years is we had to look at things like storage, which was a big area that we looked at in detail of what's happening on the storage side, what's happening with data management and grid management, because all of these become affected with renewable energy. So it was really an approach of, okay, this is an area that of high focus, let's spend some time, let's analyze it, let's really understand it, and where's the opportunity for us to invest. Now, I'm speaking really from a private equity point of view. Obviously, our family offices had other asset classes that we're investing in, but we really saw the opportunity of what was happening in the energy sector, the dynamics in the energy sector, and then try to look at, okay, where are the investable opportunities that we could enter. And then your second part of the question was really, talking to other family offices, because obviously within the network, do we see people have a similar view? Not necessarily. I think many family offices, has been raised maybe early this morning, are hard to reach, don't necessarily know how they can go after these types of investments. We were very fortunate. We had a large team in the family office that I worked for that we were able to manage these investments. But if you don't have the team and you don't have the ability to get access to this, then you need to go search for it. I think an area like renewable energy infrastructure, which has this long-term view, is an area that I think a lot of family offices could get into, although now is not the best time to invest because the yields are so low. But I think it's about educating people. If you don't have a visionary CEO of that, yes, there are definitely ways to invest, but you need to choose which asset allocation you want to go inside of, and also pick a sector as well.
Well, Ralph, just looking at your offering again, so one aspect is, I asked you if you categorize you as impact investing. How do you sell it to the market? So how do you attract institutional investors on your services? And just coming to one example, you're working for a pension fund who has dedicated a certain and a significant amount of money to you to choose the right investment managers. What is their motivation, and which other motivations do you find in the market?
Well, maybe if I may start with the motivating element first. So there's actually 3 layers that you could take. One is the team, like our firm, and I think everyone with us is with us for a good part. Of course, not exclusively. They all have to have a living or make a living because what we do, and that has to do with impact. In my case, it actually started in 1990 when I wrote my diploma paper at the University of St. Gallen on environmental funds, and that actually got me in touch and never let me go. I then spent some time in the investment banking corporate finance area, where I was also involved with corporates, where sustainability was an important element. And since 2008, when we founded EBG, that is really all we do that I described before. So the second layer then is the fund managers, and of course it helps. But it's not all if the management teams there are also in this because they would like to have a material, good long-term impact. As we heard before, they also need to be good investors. They need to be good. They need to be good in making money and safeguarding, especially the investments for their beneficiaries, and that's then the client. And you mentioned Nest Sammelstiftung before, which is a leader and a pioneer in that, and definitely in that case, they are, or let's put it this way, they made the sustainability and impact part a significant component of their whole business model. And if you look at just 2 numbers, one is their performance. So in 8 out of the last 10 years, they were able to beat the Credit Suisse Pension Fund Index in performance. And the second number is that since many years, they're growing like 8% plus, and they have to do that in a market environment because they're not a corporate fund, but they are dependent on growth from small companies joining them. The other part of your question was how do we market it? I have to say, first, we market it as attractive, good investment opportunities. And then we come in, and when we go a step further, we try and visualize how sustainability really is an important element, both on the risk and on the value driver side. And then we also try to demonstrate the impact, the general positive societal impact it has. And the reason for that is, if you work with institutionals, still, at least what we see in Switzerland, they are still in the corners that they have been for a long time. And so we have to speak their language, and we have to take into consideration what their concerns are and what they need, and help them, if you want, migrate and understand what opportunities there are that perfectly fit into their overall investment strategy.
So it's our challenge now to transfer the great stories we hear to the broader market. And coming back to Nicholas, so you told that there are also real impact investments. And may I ask you, as you said, there are two different impact investment vehicles by the structure you're working for. What is their main purpose? So you said, well, reflect the value of the foundation, or is it, well, there might be also an issue of diversification or whatever, low income environment now to get some returns?
Yes, so I think it follows its own logic. So the foundation has been a market builder in a particular space. So in the 1990s, they had a focus on microfinance, for example. We made some very strategic, we tell ourselves they were now strategic, but I think they were just good bets in the 1990s, to develop some of the infrastructure around microfinance. Some of the key networks, the first microfinance rating agency, one of the first key investors. And that was for the philanthropic capital. But as you built out that market, it actually became an investable proposition. And so we found ourselves investing, not at that stage as a fund, but as a family, into key microfinance institutions and fund managers. And so it's followed on from that kind of logic that the philanthropy should be engaged in building a market which then becomes investable. So Argidius has moved from microfinance to small and social enterprise development. How do we build that market out such that they become investable propositions, whether that's directly into high growth social enterprises or whether that's into funds serving that market? And then the impact investing fund has come along behind, as it were, into that market space, and then made very specific investments that reflect the interests of philanthropy. So you do both. And in terms of why one does this, essentially, it's a sixth-generation family of entrepreneurs. They employ 70,000 people around the world. They still have their first account book from 1843. The fifth entry was a donation to the church to feed the poor. By 1910, they're giving 10% of their profits to charity. But for a long time, you made your money here in the companies, and you did it ethically and responsibly. And then you gave some of the profits away to do philanthropy over there. And really, the left hand was not meant really to know what the right hand was doing. But increasingly, the logic of wanting to be a force for good has to run across everything you do, and therefore you begin to connect the dots. So the private equity firm, which the family owns, has to think more intelligently and coherently about sustainability. The underlying endowed foundation, which provides the resources for philanthropy, is a significant investor in its own right. And first, you might want to do that in a responsible and sustainable way. But increasingly, you may begin to think, as we have done, how to do that in a more impactful, consciously impactful way. So there's a kind of there's an underlying set of values. Everything we do needs to be done for a force for good. Those values are actually traceable back to a faith base. But you need to be able to increasingly link everything you do so it becomes an intelligible whole. So you can't run a foundation called Good Energies, which is doing renewables and forestry, on one side, and have your private equity firm investing in coal on the other. It doesn't make any sense. Now, sometimes they continue to do that because all the dots have not yet been put together. But the process of putting those dots together is fairly advanced, and you ratchet it up. Every year, it gets tighter and tighter. You disinvest from certain things, so coal is no longer a possibility. Oil is no longer a possibility. Natural gas is probably the next one to go in terms of fuel, because on your philanthropic side, you're trying to do things, and everything should, hopefully, become a coherent whole.
So it's becoming consistent, and you're even creating the pipeline for other microfinance investors that are present today, not only for your own impact investments.
Oh yes. So one of the present we've seen several times, I think, MCOPA come up, D-Light come up, both of which have been through programs that we've philanthropically supported, which have helped them develop their own strategies and plans and processes. And then we've actually been a supporter, an investor in D-Light as well. So we've actually, some of those fast growth businesses that people have referred to as sort of highlights, as it were, of this space, they've actually gone through programs that we've philanthropically funded to make them better businesses, and then we've invested in them. Yeah.
So I would like to explore a bit about your experience you did with all the investments you did, and starting with Rhea. So, well, starting with the major challenges, what challenges did you face as investment manager in this market segment?
Well, maybe I can talk about maybe some of the challenges had and have even today. And the first one is that there is money flowing into this area. I know that we talked about, we're not getting money. There is money flowing, especially when interest rates are so low. People are looking for new areas to invest, and sometimes they sort of fall upon these opportunities. I especially see that from a family office side, that you're bombarded with all sorts of investment proposals and business plans, and I've seen it many times that quite inexperienced investors or family offices or even pension funds say, well, this is great. I really want to move into this area. My friend over here, Ralph, is giving me this great deal. Sounds great. It's in Africa. And you're doing what? They've done all the due diligence. I'm going to invest. And this office does maybe one or two investments, which they consider impact investments. And unfortunately, for whatever reasons, those one or two investments do not turn out well. And then, so the reputation goes back and says, oh, well, we tried investing in impact, we tried investing in, and it really didn't work. And, we're going to step out again. And I've seen this many times, and I think, it's unfortunate because, you start to see money flow in, and then people get nervous and say, it's not working, and then the money goes out again. And, that's when we talk about investing in this area, you have to talk about a diversified portfolio. You have to especially if you're looking at the private equity side on direct investments, it's if you're going to take that kind of exposure, you need to create a portfolio of 10 investments, not one or two investments, and then you've covered your risks, or look at the different asset classes that you're investing in. But I think that's just one challenge over the years that we're continuing to fight, is that it's not just one investment went bad. You need to develop a portfolio and look at the performance across the portfolio, not the one-off investment. So the second area, and it comes up again and again, and it came up today, is that I just think we continue to have a misinterpretation, or I'd say different interpretations of what impact investing is. what is it? And we've been talking about it for 10 years. There was a question, I think, this morning or this afternoon, actually, was, well, what's the difference between a clean energy fund and a clean energy impact fund? And obviously, someone thought there was a clear difference between the two, and I would argue that what's the difference? If you're going to invest in D-Light in Africa, yes, it has a very large, potential social impact locally, versus if you invest in a large solar farm in Germany, I would argue that yes, it for sure doesn't have the same social impact, but from an environmental point of view, you're probably going to get far more reduction of fossil fuel and CO2 into the air with a large solar farm, which hopefully has a bigger impact on the planet of, helping our ozone. So, how do you judge whether is there more impact, at the micro level or at the macro level? I think all of these investments are good investments to be in, whether you want to invest in the emerging markets very locally or you want to into the westernized markets. If you're doing things that are having an impact on social or environmental issues, then there are impact investments in my mind. And if I see capital flowing into these different areas, whether it's renewable energy portfolio or a social enterprise in Latin America, I think it's great to see money flowing in all these areas. And I think that's a challenge for us. Is even I think Inge, you showed at the beginning, the impact investing was at the very bottom, but the question is, well, how is it defined? How who is behind that saying, okay, this is an ESG investment, this was an impact investment. Let's really look at what we're defining as impact investment, and let's try to educate investors out there. I think one more example is just last week I was going through a magazine and I opened up the page, and I hope there's no one from UBS here, but there probably is. But there was a big two-page spread of UBS saying, before you leave the earth, make an impact on the earth. And it was really geared towards, high net worth individuals or family offices. And at the bottom it said, UBS philanthropy. And I said, but, is that okay? Yes, philanthropy can seed these investments, but you can make an impact without having to be philanthropy. And I think we still have this disconnect with a lot of the people, financial, let's say, owners out there, whether it's a family office or institutional investors who continue to think of this as philanthropy, and we have to educate and stop that thought that yes, there's a philanthropy piece of it, but some of it is just mainstream investing. And I think if anyone went to COP21 this year, because I was at COP21, you still had some of the traditional discussions going on, but then there was other things happening that people were just getting on with business. Let's do it. We've realized we can invest in certain areas and it's going well, let's just get on with it. And I think that we'd like to see more of that.
Yeah, and Ralph, coming to your very on-earth experience, you're looking for fund managers, and do you think that there are enough products and enough good products around? And is the investment more complex for you as a manager doing the due diligence? And on the other hand, from the investor perspective, so for those who would like to invest, what are the major issues they should be prepared for?
Well, that's a lot of things that you're asking. So I would say, trying to remember all the questions, yes, there are enough managers out that allow you to build a good, well-diversified portfolio, going not only across managers and stages and vintage years, but also regionally or geographically and from an underlying asset or sector perspective. I think that, maybe the most important, as I tried to explain before, responsibility we have is to safeguard investors' capital, because that is there to also generate the returns from which retired people have to live from. So this is also part of the sustainability question, of course. And I think it comes back to what Rhea said. It is not a conflict to invest for good return and have a positive impact on society. It is, in that sense, maybe a bit more challenging that you have to combine both. But on the other hand, if it makes sense to look at the, say, environment, and again, we're in the definition question, any factors that are good impact and have a positive impact also financially because they lower risk or they provide growth opportunities or just value creation opportunities, then I think it makes just perfect financial sense to look at these non-financial information and integrate them to finally then have good investments. And when you talk about the kind of on-the-ground experience, this is of course a labor-intensive job. This is not like buying and selling securities based on a lot of public information. This means, in our case, we're 4 to 6 senior people on the ground analyzing the manager over a considerable period of time, and we're probably making about 3 investments a year, and that keeps us pretty busy. So this is a very, very different ball game. But we think, yes, opportunities to sum this up are there. They can be found. There's definitely entry barriers or information barriers, but they can be overcome, and we think it's paying out, both financially and from an impact perspective.
Nicholas, I would like to come back to your personal experience. So you've been running a microfinance fund before for Oxfam. Now you're on the other side as an investor or representing investors. Did you see that there was a development in the market, that it improved?
I think the challenge that certainly foundations face in sort of making that transition to allowing more of their underlying portfolios to be aligned to their mission is that well, there are various factors. So one is, I think that most foundations obviously don't manage their own money. I mean, they don't invest their own money. We're in the privileged position where we actually invest, have our own teams, and we can invest our own money, and basically the line of control is very straightforward. But if you've been working with the same fund manager for a period of time, and then one of your trustees or the director of the foundation decides, wouldn't it be really great to align more of our resources and our endowed resources rather than the income against investment criteria that reflect our own interests, you immediately get, is your own particular fund manager capable of doing that? If not, do you really want to change your fund manager because they've been doing really well in returning a steady flow of income to the foundation? So there's a whole areas about, how do you make that transition? What are the practicalities of it? Do you genuinely really believe that you can actually achieve similar impact goals at the same time as making the appropriate level of financial return? Because there's still a very strong presumption that your first task as a foundation with its endowment is to maximize your return so you can spend it on your philanthropic interests. And whatever people say in terms of I'm going to call it propaganda, but I don't mean that in a negative sense, that still has to take a lot of convincing. And particularly as there may well be a generational shift in your trustees, not to say that all trustees are ancient, but they often are, or relatively ancient. So there's a whole sort of cultural shift to take place there. But I think there's an important piece, which is around this question about impact, because actually genuinely measuring impact is a real challenge. So you can measure outputs, you can even possibly measure outcomes with some reasonable level of success, but impact is more challenging and complex. And it's probably an unfortunate word. I know why people chose it, because it sounds so, positive and direct and forceful. But in the world of actually carefully, particularly in the kind of space that I work, in the development space, actually measuring impact is very hard. So that immediately then you're asking people who know it's actually quite difficult to measure impact to go down a pathway of doing impact investing, where actually what you're really doing is you are having an impact, but the criteria and the measurement is still a work in progress. a significant work in progress. And so there's a kind of cognitive dissonance if you're moving between these two worlds. And so I think that both of those are real challenges to making this kind of transition. And also because, of course, every foundation in particular has a whole series of stakeholders, whether that's the trustees, whether in our case it's a family foundation, it's a large family. So building alignment is often a challenge, and therefore the opportunities to actually pilot something often off there somewhere. And often foundations have done that through program-related investments using their income as distinct from their endowment first to be able to demonstrate that this works is probably another route to getting them online and on board.
I'd like to come back directly to your perspective on foundation, because there's now more pressure on foundations to align their mission with their investments. So the recent update of the Swiss Foundation Code imposed that foundations should consider more the impact of their investments. And well, you said it's not the case yet, and you already mentioned some issues that have to be tackled, like, okay, it's a generation question. Some opportunities like, okay, if pilots can work, do you see that there are other hurdles that should be overcome to create more activity?
Well, I think being clearer about the definitions of what you mean. So when one says sustainable, so what does that actually mean? And I think because you're asking people to do something different or perceivedly different, and you're more likely to get people to do something that's perceivedly different if it's clear. And if you're not clear about what sustainable means, people can say, well, aren't our investments sustainable? And likewise for the word impact, aren't they impact investments? And so. And then in the space still, there are still, as it were, overlapping and competing definitions of what we mean, and so it's not necessarily a driver of change to have that level of unclarity or perceived unclarity, because it also then means that the foundation, depending on its resources, has to work out usually its own definition of what it means, and there may well be resource constraints on that. There may be intellectual constraints on that. They may just go out and take one off the shelf and apply it accordingly. But it is requiring people to do something that is acting into what appears still to be a degree of unclarity and uncertainty. And most people don't like acting into unclarity and uncertainty. And in my experience, that's often true of trustees of foundations.
Okay, so I forward this to the market, at least to the current participants. And then, Rhea, I asked you about the challenges, but which success factors now do you see and have you experienced that can motivate other family offices to enter into this market segment?
Yes, good question. I've spoken to a lot of family offices, and the impact space can be very daunting, in part because we aren't clear necessarily on the definitions. And the question is, should I be looking at CO2 credits? Should I be looking at renewable energy? Should I be looking at social change in Africa? Should I be looking at, it's a vast area to look at. And I think the most successful family offices that I've seen come in with a real strategy. And it doesn't have to be, well, I want to invest in this particular investment in Africa, but really a strategy of maybe from a risk-return profile, what you're going after. One family says, we have to take a very risk-averse approach. We're willing to accept 4 or 5% yields. We're willing to hold assets for long term. We want to get in the renewable energy. We don't want to invest in the emerging market. It's very conservative. We stay in Europe. But that's fine, because I think there's an asset class for that family to invest and have a very successful investment. I just this week spoke to another family who's also a bit lost in the impact space, having different meetings all over the place trying to figure out where to invest. And it's clear, they're interested in doing something in climate change. And of course, climate change is a huge area as well. And so it's really to say, okay, what kind of asset classes you want, what kind of return are you looking for, and try to focus in on specific areas and get people to help you to really understand those areas, because you can't cover it all. And people who tend to be more focused and say, yeah, I want to do something in the emerging markets. I don't want the direct investment exposure. Maybe I want to go through private equity and look at some funds, and I need to look at those products. Then you're already narrowing in on what you want, or maybe specific asset classes that you want to go in. You don't want to be in private equity. You want to be on the other side. So I think really taking time and thinking through your strategy, and it doesn't have to be, understanding exactly, you don't have to know the investments up front of what you want to invest in. And it goes back to the discussion I think a lot of people have been having is have a mission and understand what's important for you. Maybe one more example, another family who, they were very passionate about education, but they would be advised by a bank advisor who had them invested in a bunch of funds and liquid assets, and maybe didn't make the connection that actually they could take some of the funds from the family and invest in education, because there was opportunity there. And so taking that, the mission part of it and funneling more funds towards the mission, and then saying, okay, where can we look? I want to invest in education, but I want to stay in Europe. I don't want to go to emerging markets. Where's the opportunity? And focusing in there. And there, I've seen a lot of successful investments and a lot of successful family offices. So keep focus and decide what your mission is.
But from the other side, I also assume that this also implies a much more individual consultancy process to get into this space.
Definitely, there's definitely some education, I think. First of all, to think through the options out there. It may be hard for people who don't have any knowledge in this space to really understand, well, what's the impact on carbon credits versus, other areas or education they want to invest in. It gets very confusing. So there's definitely an educational piece that people need to consult people who have a lot of information in those areas. There are family offices that have larger teams that they built up over time that specifically look at areas, and those are, I'd say, more advanced family offices. But I would say, some of the smaller ones are really looking out to expertise in the field who can get some advice to say these are the areas that could be interesting to invest in, giving your particular interest or mission that you're looking at. But yeah, we've got some ways to go, I think, to get people educated on the different opportunities out there.
So my last question now addresses Ralph, and as he's very experienced with pension funds, so what do you think are the key factors to drive, to get these, return-driven investors into this market segment?
Well, I think from the work we do on a daily basis, I would say it's really skills and experience, and then to overcome that, because not everybody can have or hire his own team, is to really help them navigate through, the jungle of opportunities, and knowing that we are in a transition. I think not only in respect of the type of investment and how we define them, but also the underlying markets and sectors are in huge transitions. And I think part of that, if we call it navigation, is also to really help a client, even if he doesn't have his own team, but the committee who decides on investments, to really get up the learning curve. So we spend on the job, really, when discussing investment opportunities and then maybe even final investment propositions, we really spend time. We give them a lot of information in a way that we make good use of their time that they can spend on that. So they learn by investing, although they are not on the ground, but they see, what the opportunities are about and how they look like in the context of the market and other opportunities. That's the one end, and the other end is, of course, that we engage with the managers in respect of their investment strategies and the investments they have done, and also how they measure impact.
So thanks from my side.